Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The US dollar has been trading in a tight range against its major rivals for the past 2 weeks, and the dollar index is gently forming a bottom after an impressive oversold condition. However, traders are advised to be patient. Last August, the dollar was similarly oversold, which coincided with weakness in US equities. It took more than a month for the dollar index to strongly rally. In other words, a low relative strength index is not in itself a buy signal. One should not fall into FOMO and look for a low to buy. It makes much more sense to join the uptrend when it is already in place. Earlier this week, the Fed sent a mixed signal to the markets. On the one hand, it lowered its GDP growth forecast for the current year, but also raised inflation expectations. The former brings us closer to a rate cut, while the latter makes us wary of a spike in inflation, as we saw 3 years ago. Powell is hardly a hawk. He is quite reactive to the stimulus to cut rates, but has more than once delayed action when it is necessary to raise rates. This time, too, he will likely be tolerant of some increase in inflation if he sees weakness in the labor market or consumer demand. The major U.S. indices have been rallying since the end of last week and gained even further ground this week, following the FOMC's post-interest rate decision comments. As we warned last week, oversold conditions in equity indices attracted buyers, and the S&P 500 added over 3% to last week's lows. Meanwhile, the index remains below its 200-day moving average, suggesting that the bears continue to dominate. CNN's Fear and Greed Index is still in extreme fear, despite a steady recovery since early last week. A rebound to levels above 25 here could be followed by more active buying in equities. For now, that moment is just around the corner, and it is worth being patient and cautious, so as not to fall into the bear trap of increased selling after a small rebound. The main factor weighing on equity markets is the growing fear of an economic contraction or recession as a shock from the tariff wars. However, the markets have seen it all before in the first term of the Trump presidency. Then, as now, there was a lot of media noise and international chatter, but the global economy did not go into a downward spiral, and the risk of a repeat of the tariff wars of a century ago remained just a scary story. Gold has been in an uptrend since the beginning of March, and the rally accelerated as gold hit new highs at the end of last week, when the spot price hit a new record of $3,057. We see this breakout as the start of a new expansionary momentum with an upside potential of $3,180 per ounce, which represents 161.8% of the upside momentum from the start of the year to the February peak. The alternative view is also bullish. According to it, gold has completed a correction since the beginning of the year, following the rally from October 2023 to November 2024. The bulls are now targeting the level of $3,400 an ounce. This seems like the bulls' target for the coming months. However, we should not lose sight of the fact that the current rally in gold is accumulating extreme overbought conditions on both the daily and weekly timeframes. This disposition leaves room for sharp rallies in the near term on a short squeeze, i.e., liquidation of short positions. However, the pause in growth may well be followed by a broad correction, which we will be sure to report on in the future. The cryptocurrency market has been on the rise, growing by over 5% since Tuesday, and reaching a total capitalization of $2.81 trillion. Optimists are hopeful that, after hitting recent highs, the market is ready to shift towards growth. However, despite this excitement, it's important to note that the crypto market has yet to break above its 200-day moving average, currently sitting close to $2.9 trillion. A strong rally above this level could trigger an active buying phase, but there's also a risk of bears setting up a trap, as they've done several times before. Sentiment has improved, though. The Fear and Greed Index climbed back to the middle of its range by the end of the week, a level we haven't seen in 4 weeks. This shift out of the extreme low zone could be the first sign of a trend reversal, suggesting there's still plenty of room for growth. Bitcoin has been showing steady progress, with a nice bounce on Wednesday. Thursday morning saw a brief spike, pushing the price of Bitcoin above $87,300, its highest in 2 weeks. This was an attempt to break through the 200-day moving average, but the rally was short-lived. For Bitcoin to maintain momentum, staying above this key level is crucial. If it does, it could spark renewed interest in buying a variety of coins that have been in a correction phase for a while. The new week will start with the first estimate of the PMI business activity indexes for March, which will be influential for the single European currency. In recent months, this indicator has picked up considerably, which has helped equities and the euro. There are growing expectations that not only the service sector, but also manufacturing activity will return to growth territory after many months of contraction. On Wednesday, it is worth paying attention to the UK inflation figures, where we see an acceleration since October. This is an important reason why the Bank of England is not cutting rates. Analysts, on average, forecast a slowdown from 3.0% to 2.9%. Deviations from forecasts will drive the pound. Friday sees the release of personal income and household spending statistics, and the Fed's preferred measure of inflation. There was a slowdown here in January. Will it persist in February? It won't be easy for the dollar to continue strengthening, if that's the case. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.